Vail Research, Uniform Financial Analytics.
For those who don't know Vail, of course, Vail owns a bunch of ski resorts, right? It has been an aggregator of ski resorts, a roll-up of ski resorts for the last 10, 15 years. And when we look at this, right, what you can see here is we're coming to the page that every single person comes to the first time they get to a company under the Vail Research app and in Uniform Accounting, which is the PVP page or the Performance and Valuation Prime page. Again, we're very literal here at Vail, which is why performance and valuation, why do we call it that? Because these first two charts around adjusted uniform accounting return on assets and uniform accounting asset growth are about performance. How has the company's operating performance been for the last 15 years, and what's it forecast to do? Then we look at valuation, our valued asset prime ratio, which is a cleaned up price to book, and our valued earnings prime, right? Performance and valuation prime. Why prime? Adjusted accounting analytics, they're uniform accounting metrics. So when you look at this, the first thing we look at is in terms of ROA, return on assets, which is to us the base of any smart analysis on a company. We start by showing you what the as reported, right, the GAAP distorted as reported ROA of this company is, and then what the uniform accounting adjusted true blue corporate profitability of this business is. What's really interesting and jumps out to us here is when we look at the last 15 years of historic profitability, right? Over really until 2016, as reported in uniform accounting metrics didn't diverge that much. But look at what's happened in the last 3 years. Somebody who's analyzing Vail, as Vail has really turbocharged their, their, if you will, season ticket strategy, et cetera, people think that they've kind of plateaued in the profitability they can get from that strategy. Returns have been flat at around 7% for the last 4 years. The reality, that's not true at all. Returns have continued to improve all the way through to 2019, right, where they took a modest step down because of the fact that that season ticket strategy is actually still having phenomenal fundamental tailwinds for the business. If you were trying to analyze this company and recommending what management should do, you should tell them to stop focusing so much on the season ticket strategy if you're looking at as reported metrics, because they're not getting any benefit from it. It's only when looking at the uniform accounting analysis do we see that it's actually continuing to do very well and management should support it. But we don't just stop there. We also look at the asset growth the company has. Again, looking at the distorted as reported asset growth versus the uniform accounting adjusted asset growth to understand not just how good is the company in terms of profitability, but is the company also able to grow its asset base, right? And for Vail's purposes, it's intermittent in terms of its growth of its asset base because it really only grows by acquiring other mountains to roll up. Then we look at valuations. The first thing we look at is valuations relative to assets, right? We look at price to book equity traditionally, or our adjusted price to book to see, and what we see is there's inherently a very strong relationship between the return on assets a company generates and the multiple it trades at relative to its asset base. Just thinking intuitively, if the market has a required rate of return and a company generates that rate of return, let's say it's 5%, it should trade at 1 times its asset value, right? Because it's generating the return the market needs. As it expands, look, as we can see here, ROA coming down, VA coming down, ROA going up, VA going up. At a certain level, it's actually predicting it. And so what we're looking for here is we're monitoring that uniform accounting valuation to understand is there a dislocation between returns and what the market's pricing in. We also look at valuation relative to earnings, right? A traditional PE and our uniform accounting adjusted PE, again, the same idea. We're looking at where valuations in reality and are those reasonable based on the company's cash flow forecast. The last chart that we're going to look at here is TSRR. TSR relative to the market. Total shareholder return is what TSR stands for, by the way, for those who don't know. Total shareholder return is the total stock appreciation and dividend income that an investor receives from a company on an annual basis. When it's R, right, the second R, relative to the index, which for this company, since we're looking at the American company, the S&P 500. When this line is flat, that means the company has performed in line with the market. When it's rising, that means the company has performed better than the market. When it's falling, the company has underperformed the market. And lo and behold, look at this. As we can see, uniform ROA, as it has grown and shrunk, literally TSR has basically tracked that perfectly. You can even see here, right, it ignored the plateau in ROA that you're seeing since 2016, and it saw that returns were continuing to improve just like uniform accounting did until they started to fail off and then it actually trailed off. The market listens to uniform accounting data. You can see that time and time again. But understanding historic profitability is not enough to understand if a stock is a buy or a sell. We need to understand is what the investment grades talk about, which is what is the market pricing the company to do in the future, and is that reasonable or too bearish or too bullish? Because that can help us decide whether or not we think the company's undervalued or overvalued. And that's where these 5 future bars come in. These are the forecasts of the company. The 2 light blue bars are what sell-side Wall Street analysts forecasts are for return on assets and for asset growth when we take their as-reported EPS, revenue, net income, EPS, net income, revenue, CapEx, et cetera, estimates, and we push them through the uniform accounting model. These white bars are what the market is pricing the company to do at an $8.5 billion market cap and a $212 stock price for the company right now. So the question is this reasonable or isn't it reasonable? And so that's when we get into the idea of, right, this company before the disruption for the pandemic, it had mostly been seeing ROAs expand. And if it had from its two naked order strategy, if they continue, what reason is there to believe that once they recover in a year or two, returns can't just expand another 200 basis points? So they've expanded 300 basis points, 300 basis points, 300 basis points, 200 basis points over each of the prior years up until 2019 when they took a minor step back. That to us looks like a company that if they can continue to drive this strategy, they've actually justified this valuation. But if you were looking at this with the as-reported metrics, you would say, well, ROAs have plateaued. Why would you be paying for ROA expansion? The strategy has already run its course. So that's what's so interesting is uniform accounting changes how we can think about valuing the business. Because let's say actually I think, hold on, 2021, I actually think they're going to get back to 2018 numbers because just it's the fact. And then I think that they're going to see from 12% this year, they're going to see a 200 basis point rise in ROA each subsequent year. So 12, 14, 16, 18. If I plug in 18% for ROA and I say, what would the stock be worth if this company did that? I can do a very quick scenario analysis here. And I can see if this happened, the stock would be worth 10% upside, $230, not $212. Let's say that I actually think that from 12%, it's going to go 15, 18, and 21. I can do that kind of analysis too. So when you're meeting with your analysts and you're having a conversation, or even when you're meeting with a client and walking them through why you like or don't like a stock that they're curious about, you can quickly do the scenario analysis with them to understand what makes sense and what doesn't, right? Even if this company saw ROAs increase to 21%, it would still only be 30% upside. Not a lot of upside, but at the same time, we understand why the market's pricing what it is, so we can understand why we shouldn't be betting against it either.
Vail Research, the world's leading source for uniform financial analytics.